Reading a Forex chart sounds simple on the surface. You look at price, you identify direction, you make a decision. But that's not really reading a chart. That's just glancing at one. There's a meaningful difference between looking at price movement and understanding what that movement is telling you. And for traders working on higher time frames, people who hold positions for weeks at a time, that difference matters enormously. Chart reading is not about finding signals. It's about identifying the perfect entry. At its core, it's about building an accurate picture of market's structural dynamics. Where is price in relation to a recent history? What is the dominant pressure right now? Where has price shown a strong reaction before, and why might it show one again? These are structural questions, and the 5 techniques I'm going to walk you through in this video are the tools I use to answer them. A Forex chart is a visual record of price over time. That's it. It shows you where a currency pair has been across whatever time frame you're looking at. The vertical axis is price, the horizontal axis is time. Every bar or candle on the chart represents a specific period. 1 day, 1 week, 1 hour, and tells you where price opened, where it closed, and how far it moved in between. What a chart is not is a prediction engine. And this is worth saying clearly because a lot of chart analysis gets framed as if the chart is telling you what will happen next. It isn't. It's telling you what has happened. How you interpret that history and how you apply it to your current thinking is where the analytical work begins. There are 3 common chart types. Line charts connect closing prices and give you a clean, simplistic view of direction. Bar charts show you open, high, low, and close for each period. And candlestick charts show you the same data as bar charts, but in a format that's easier to read visually. Most position traders use candlestick charts because they convey more information at a glance without adding clutter. Understanding the chart itself before you add any analysis is the first discipline. You're looking at a structured record of market behavior, and the 5 techniques we'll cover are simply different lenses for reading that record more clearly. Forex charts exist because prices don't move randomly. It moves in patterns that reflect the collective behavior of buyers and sellers over time, and those patterns carry information. Trend analysis exists because markets have momentum. When a currency pair is making higher highs and higher lows, something structural is happening. There is persistent buying pressure. Capital is flowing in one direction. That doesn't mean it will continue forever, but it does mean that going against that structure carries more risk than working with it. Support and resistance exist because price has memory. When price reaches a level where it's reversed many times before, that level represents a zone of historical significance. Buyers and sellers who acted at that level before are likely to act there again. Momentum indicators exist because direction alone doesn't tell you everything. A market can be trending upward while losing internal strength. Momentum tools help you see the difference between a healthy trend and one that is quietly deteriorating. Candlestick patterns exist because individual price bars tell a story. A single candle reflects the battle between buyers and sellers during that specific period. Patterns like engulfing bars, hammer candles, and doji formations reveal shifts in that balance. And chart patterns, flags, triangles, head and shoulders formations, they exist because price consolidation and price structure tend to repeat. Markets breathe, they move, pause, and move again. Recognizing those phases helps you understand where price is in its larger sequence. Each of these tools emerge because the market produces consistent, observable behavior. These techniques are attempts to read that behavior systematically. I don't treat these 5 techniques as a checklist. I treat them as a layered framework, a way of building a complete picture before forming any opinion. The starting point is almost always trend. What is the dominant direction in the time frame that matters most to me? Is price making higher highs and higher lows, or the opposite? Is there a clear structure at all, or is the market chopping sideways? And from there, support and resistance provide context. What are the significant levels relative to the current price? Is price trading near the top of a range or the bottom? Is it approaching a level where it has reversed sharply before? Momentum adds a second layer of confirmation. If price is in an uptrend and momentum is strong, that's a coherent picture. But if price is rising and momentum is weakening, that's a tension worth noting. It doesn't mean you act on it immediately. It just changes how you interpret what you're seeing. Candlestick patterns are used more selectively. They don't make decisions on their own. They add weight. A bearish engulfing candle forming right at a major resistance level in the context of weakening momentum and a mature trend carries more information than the same candle appearing in the middle of a clean uptrend. Chart patterns provide structural context at a broader level. A bull flag forming after a strong directional move tells you something different than a symmetrical triangle forming after months of choppy, directionless price action. The right approach is integrative. None of these tools stand alone. Each one adds a layer to the overall picture. The most common mistake with chart reading is treating these techniques as independent signals rather than as components of a unified analysis. A trader sees a hammer candle and thinks that's a buy signal. A trader draws a support line and thinks price must reverse there. A trader sees a bull flag and expects it to break to the upside every time. None of these is how these tools work. Each technique has a context where it carries meaning. Remove the context and the signal is unreliable. A hammer candle at a major support level in an established uptrend is meaningful. That same candle in the middle of a downtrend with no structural reason to expect reversal is just a price bar. Another breakdown happens with time frames. Chart reading on a daily chart tells you something very different than chart reading on a 15-minute chart. For position traders, the higher time frame is the one that matters. Weekly and monthly charts reveal structural behavior that daily charts can obscure. When traders spend most of their time on lower time frames, they often lose sight of the larger structure and make decisions that work against it without realizing it. There's also a tendency to apply too many indicators at once. More analysis does not mean more clarity. Often, it means more noise. The goal is a clear, coherent picture built from a small number of well-understood tools, not a chart covered in lines and indicators that all need to agree before you can see anything. For position traders, chart reading is the primary analytical lens. It's how you orient yourself in the market before anything else. Trend analysis is central to position trading because positions are held through movement. You need to know whether you are working with a dominant trend or against it. Getting that wrong is expensive when you're holding for days or weeks. Support and resistance are essential for framing risk. Where would a position be invalidated? What levels carry historical significance? These are structural questions that direct chart reading answers. Momentum is useful as a filter, not as a trigger. For position traders, momentum divergences on a daily or weekly chart can signal the early stages of a trend change, long before it's visible in the price alone. That kind of early warning has real value over a longer holding period. Candlestick patterns are most useful for position traders at key structural levels on higher time frames. A single candle on a weekly chart carries far more weight than a pattern on a 15-minute chart. The time frame is always part of the interpretation. What chart reading does not replace is fundamental context. Currency pairs are driven by macroeconomic forces, interest rate differentials, economic growth divergence, and central bank policy. Chart reading shows you what the market is doing. It doesn't always tell you why. And for position traders, holding both the structural picture and the fundamental backdrop together is what separates durable analysis from pattern matching. Chart reading is a discipline built over time. It's not something you master in a weekend. It deepens the more you study it, and the more you apply it honestly without forcing the market to match what you want to see. The 5 techniques covered in this video, trend analysis, support and resistance, momentum, candlestick patterns, and chart formations, are not a trading system. They are a language, a way of reading what the market is communicating about its own structure and behavior. For position traders, that language matters because every decision you make is made in a context. You're not reacting to the last few candles. You're forming a view based on what a chart has been saying over days, weeks, and sometimes months. The clearer you're reading, the more grounded that view becomes. If you want to go further with this, the full article, How to Read a Forex Chart and 5 Ways to Enhance Analysis, is linked in the description. It covers everything discussed in this video in complete detail, including chart examples for each technique. You can also download the 6 basics of chart analysis directly from positionforex.com, the foundational framework used for all analysis on this channel. Until next time, best of your trade.